On a quiet Sunday evening, when most traders had already closed their screens, when retail investors were scrolling socials instead of charts, something broke in the silver market. $106.5. Not during regular trading hours, not with headlines, not gradually, in minutes. And the real question isn't just what happened. The real question is what failed underneath the system to allow this to happen at all. Because when a market moves like this in the darkness of off-hours trading, it isn't sending a signal, it's issuing a warning. Pause. 2 seconds. Welcome to the money shift. If you've lived long enough to build something real, if you've stewarded capital through more than one cycle, then you already know this truth. The most dangerous financial moments don't arrive with sirens. They arrive quietly when nobody is watching. Do me a favor, hit subscribe, not for entertainment, but because informed decisions require analysis that doesn't insult your intelligence. And drop a comment. Tell me where you're watching from. London, Singapore, New York, Sao Paulo? Because what we're about to break down doesn't stay contained to one market. Let's begin. Most people weren't watching. It was Sunday evening. New York and Chicago trading floors were dark. Institutional desks were running skeleton crews. Retail traders were offline. And that's exactly when it happened. At 6 p.m. Eastern, Globex opened its overnight session. Globex is where foreign institutions operate, where algorithmic systems execute while American traders sleep. And within minutes, silver futures exploded higher. Not over hours, not with buildup, straight up. Anyone watching live knew immediately this was not normal price action. To understand why, you need to understand what Globex represents. During regular hours, silver trades with depth. Market makers provide liquidity. Commercial hedgers balance flow. Thousands of participants create orderly markets. After hours, that structure disappears. Liquidity thins, and in thin markets, prices usually drift or fall. When panic hits and bids vanish, markets drop. But violent upward moves in thin markets tell a very different story. They tell you someone needed exposure immediately. They tell you size hit the market without concern for price. They tell you urgency. This is not how speculators behave. Speculators wait for liquidity. They scale in. They minimize impact. This was something else. Silver is different from most commodities. Most futures contracts are paper. They're never delivered. Positions are rolled. Exposure is synthetic. But some contracts do stand for delivery, and when they do, the exchange must have physical metal available. That's where things get uncomfortable. Registered silver inventories at COMEX, metal actually available for delivery, have been sitting near historic lows. At the same time, open interest remains elevated. More claims, less metal. This imbalance has been documented for months. Analysts warned, data was public. It was ignored until Sunday night. Because that price move wasn't paper speculation. It was a glimpse of what happens when paper promises collide with physical scarcity. Look beyond futures. Physical silver coins and bars have been trading at persistent premiums, $4 to $6 above spot, sometimes more. Dealers report sourcing problems. Mints are delayed. Refineries are stretched. Abundant markets don't behave like this, and yet they are. So when silver explodes higher while the world sleeps, it's not drama, it's diagnosis. Now we need to talk about the real imbalance. 13,000 tons. That's the approximate annual gap between how much silver the world mines and how much it consumes for 3 consecutive years. Think of it like a reservoir draining faster than it refills. At first, no one notices. Then suddenly, the buffer is gone. That's where we are. Silver mining has a problem it can't solve quickly. High-grade deposits are gone. Ore grades are declining. More rock, more energy, more cost for less metal. And here's the part most people miss. About 70% of silver isn't mined for silver. It's a byproduct of copper, lead, and zinc. That means even if silver prices spike, production doesn't automatically rise. If copper demand slows, silver supply falls, regardless of price. Now look at demand. Solar panels require silver. There is no substitute at scale. Solar silver demand has surged from around 100 million ounces to well over 150 million ounces in just a few years, and rising. EVs use far more silver than combustion vehicles, 25 to 50 grams per car. Production is tripling. 5G infrastructure adds another layer. Defense spending is accelerating. Medical demand continues climbing. Every single demand channel is growing right now. Supply is not. Above-ground inventories are being drawn down. This isn't a temporary disruption. This is structural. And Sunday night wasn't the start. It was recognition. Now zoom out. In 2020, central banks created more currency in 90 days than in the previous century combined. That isn't a stimulus. That's dilution. And sophisticated capital understood this immediately. Central banks didn't buy currencies. They bought gold. But here's what doesn't make headlines. Gold is monetary. Silver is monetary and industrial. Gold stores value. Silver powers the systems governments say are non-negotiable. That dual demand is the asymmetry. The gold-to-silver ratio still sits far above historical norms. Silver is cheap, relative to what it does. And now the global monetary system is fragmenting. Trade is being settled outside the dollar. Reserves are being diversified. Trust is eroding. Frozen reserves taught the world a lesson. Paper claims are permissions. Physical assets are ownership. That's why precious metals matter again. And when silver moved Sunday night, it wasn't just pricing metal. It was pricing uncertainty. So what does this mean going forward? The base case is simple. Structural deficit continues. Demand grows. Volatility increases. Price trends higher, unevenly. The bull case is nonlinear. Supply shocks. Institutional demand. Paper breaks from physical. The bear case exists, but requires demand destruction or breakthroughs that don't currently exist. Probabilities matter, and the probabilities point one way. For manufacturers, this changes procurement strategy. Just-in-time becomes risk. Spot exposure becomes dangerous. For portfolios, silver becomes a strategic asset, not a trade. Position size matters. Volatility matters. Structure matters. Ignoring it is the only wrong move. And the lesson extends beyond silver. Cheap abundance is ending. Resources are repricing. Efficiency gives way to resilience. Lowest cost gives way to secure supply. Sunday night wasn't an anomaly. It was a preview. And the people who understand that aren't asking if it matters. They're asking how to position before everyone else realizes it does.